Yeah, welcome back to another session. In this session, we are going to look at capital gain tax. We begin by asking ourselves, when did the tax begin, or when was it introduced? And we also see the computations, how you arrived at the taxable amount. And finally, we look at how to declare such information in iTax portal. Now, guide us, we are going to get credible information from KRA portal. So we are going to look for KRA Home. We'll go to KRA Home. And then on individual here, we look at capital gain tax. Now, by introduction, we are saying that capital gain tax is a tax that is levied on, one, gains which accrue to a company, an individual, or partnership on or after 1st January 2015 on transfer of property situated in Kenya, acquired on or before 2015. Of course, this one has since been revised. Then, if you simply what you are trying to say here is, if you are acquiring a property in Kenya, both financial and real estate properties, you are entitled to pay capital gain tax at the rate of 15%, which is a final tax. You don't declare that income anywhere else, even if it's a company. The extra amount is exempted from taxes. So once you pay capital gain tax, that becomes a final tax. And it's a tax on transfer, meaning the ownership is changing from one person to another. Otherwise, if you are transferring the property from one company to another company and you are the directors of those companies, then it means you are still the owner of those properties. Now, gains arising from the sale of shares or comparable interest in foreign entities, which derive more than 20% of their value directly or indirectly from immovable properties situated in Kenya, to a capital gain tax in Kenya effective January 2023. Now, what we are trying to say here is, properties here, we have financial assets and we have real assets. Financial assets here, we have shares. If you're transferring ordinary shares, preference shares, you are transferring even bonds, they are financial assets. Yeah. But now, we are told here that similarly, capital gain tax will also apply when a non-resident person who holds more than 20% of the share capital of Kenya company, directly or indirectly, disposes of their interests. Now, when you come to non-resident, there is a threshold as to when he or she can pay capital gain tax. You are told he has to have 20% of the share capital in Kenya. Yeah. Now, what is the tax point? The tax point is at the point where you are supposed to remit the taxes. Capital gain tax is charged at the point of transfer of property. That particular time the property is moving from one person to another, the transferor will be required to pay capital gain tax. This is upon registration of the transfer instrument in favor of the transferee, indicating the transfer of interest in the property from the seller to the purchaser. Capital gain tax is declared and paid by the transferor of the property. You are the one transferring the property. You are the owner. Then you are the one to pay capital gain tax. Remember, when you are disposing assets, there are other expenses. We have stamp duty, we have legal fees, and the rest. Those you are going to see where they are captured because they are allowable, except the taxes. Stamp duty is a tax, and tax is not allowable expense. Other legal fees, you're going to see the allowable expenses in computation of capital gain tax. The rate is at 15% of the net gain. If you bought an asset at 15 million, you sell an asset at 17 million, the capital gain tax is on 2 million, not on 17 million. Yeah, it is the tax on the net gain. And in this case, you're saying the difference between the buying and selling prices. It is a final tax, meaning that once you pay the capital gain tax, there are no other taxes to be paid in the future. So capital gain tax is not subject to further taxation after payment of the 15% rate on tax. We also told that the net gain in sales proceed minus the acquisition and incidental costs. In other words, they are trying to define what do we call a net gain. You have sold a property, but there are incidental costs like even maybe you are not in the country. You took a flight to come to country to sell your property. You have legal fees. You have let's say things like even accommodation, as long as they were utilized for the sale of those for the sale of that property. Now, capital gain tax is on gains arising from the sale of property. Gains, remember, it is not on the selling price, it is on the gain. The same thing we normally do with companies' taxes. We normally tax the profit. We don't tax the sales. Similarly, when you are calculating the capital gain tax, we tax on the gain. Now, how to compute capital gain tax? We are saying that when you want to compute the capital gain tax, you should work with the net gain. And the net gain, in this case, we're talking of the transfer value minus incidental costs on transfer. Incidental costs, they are the costs that are arising due to the interest of disposing that asset. Yeah, I've said maybe by the time you want to sell that asset, you needed to have a legal representation. Maybe you wanted to make sure things are within the law. That is an incidental cost. Adjacent costs, these are costs that arises due to some adjustment. Yeah. Then acquisition costs and incidental costs of acquisition plus any other enhancement cost. You shall look at this in details when we log into iTax and see how the incidental costs are being computed. What constitutes a transfer? We ask ourselves then, when do we say that a property has been transferred? One, if a property is sold, a property is exchanged, or otherwise disposed in any manner, including a way of gift, whether or not for consideration. And at this point, I should mention something. When you are selling a property that is residential in nature, then you are exempted from capital gain tax. Yeah. If you're selling a property that is commercial, then you pay capital gain tax. Yeah. When I'm talking about residential in nature, I'm talking about a house. Yeah. On the occasion of a loss, that is what you're not talking about, a transfer. On the occasion of a loss, destruction, or extinction of a property, whether or not a sum by way of compensation is received in respect of the loss, destruction, or extinction, unless the sum is utilized to reinstate the property in essentially the same form and the same place within 1 year or within a longer period of time approved by the commissioner. I want you to look at this case here. There have been demonstrations happening recently. Many buildings have been destroyed. Some may not come back again. The owner had insured those buildings. He get compensation for the building that was destroyed or demolished. And he don't intend to bring up the building again. Then that means there is a sale of that property. Unless the compensation will go into rebuilding or bringing up the similar building, then that does not constitute a transfer of property. On the abandonment, surrender, cancellation, or forfeiture, or the expiration of subsidiary of rights to property, including the surrender of shares, debenture, on the dissolution of a company. So this is well explanatory. We are saying that you forfeit. Forfeit is like you give away or you forget. Yeah. If you forget those, when now you forfeit, you abandon, you surrender, you cancel any transfer of shares, then it means you have already sold or transferred those properties. Now, what are some of the allowable expenses for the purposes of capital gain tax? These are what we are calling the incidental costs. They are costs that have arisen because of the interest to dispose that asset. One, we are talking about the incidental costs here. You have the cost of acquisition. That means there was construction, perhaps, maybe additional repairs. Loan, mortgage interest, that is a cost. Cost of advertising to find a buyer. Before or once you get a buyer, you have to subtract the cost of advertising. The cost incurred in evaluation of the property, you need an evaluator to come and tell you how much is the value of your house. Legal fees and cost of enhancements. So basically, these allowable expenses, in the interest of disposing your asset, you have to subtract them so that you get the net gain. How to determine the transfer value? Selling prices for the purpose of capital gain tax. We want to see now, there is amount received for transferring the property, the sum received, or the gross pay, or the gross income, or the gross revenue. This sum is in return, or sums received in return of abandonment, forfeiture, or surrender of the property. If this amount you receive in respect of selling a property, we call that one gross income. Then amount received for the use of exploitation of a property, e.g. rent, okay, that is another issue. Compensation received for damage, injury to the property of the loss of the, or the loss for the property, that is another gross income. Insurance policy reimbursement in respect of the injury or loss or damage of the property. Simply, we are trying to figure out what do you call the net, or do you call the sale or the prices or the selling prices of an asset in respect to capital gain tax. And I began by saying that when you're talking about assets, we are referring to both real estate and financial assets. Now, there's some exemption in related to capital gain tax. We are saying that income that is taxed elsewhere, as in the case of property dealers, you exempt that one. Insurance by a company of its own share and debentures. That means you're insuring your own property. That means there is no transfer of property there. Transfer of property for the purpose of only securing a debt or a loan. You are exchanging these properties for the interest of having a loan. Then you are exempted from capital gain tax. Transfer by a creditor for the purpose only for returning a property used as security for debt. Yeah, basically there is no transfer there. Transfer by a personal representative of any property to a person in beneficiary in the course of administration of estate of the deceased person. Transfer of asset between spouses. You are selling an asset to your wife. You don't pay capital gain tax. Transfer of asset between former spouses as part of divorce settle agreement. You are exempted from capital gain tax. Transfer of asset to immediate family. When you're selling a property to your dad, you don't pay capital gain tax, or even your uncles. To a company where spouses or spouse or spouses are immediate family members hold 100% shareholding. You are transferring to a company that you also have interest, or you are related parties. Private residence of an individual owner has occupied the residence continuously for 3 years period immediately prior to the transfer concern. So I said, when you are selling your private residence, you can see that a private residence, if the individual owner has occupied the residence continuously for 3 years, you are exempted from capital gain tax. You are selling your own land, which you have been. So basically, the capital gain tax should be viewed in the sense like you are doing a business. Yeah. You are doing a business of real estate. Yeah, that's when I want you to view that in that angle. Not necessarily, even if you are selling asset, when you're selling your ordinary shares, of course, that now you are not transferring that to your children. You are transferring that to an interested buyer. Then in that case, you'll have to pay capital gain tax. Now, a transfer of property as a result of internal restructuring within the group, which has existed for at least 24 months and which does not involve a transfer of property to a third party. So basically, those are some of the exemptions we normally have when it comes to capital gain tax. How do you pay capital gain tax? The capital gain tax is charged at 15%. And this is what you do. You have to prepare a small income statement of your transactions, which has the revenues against the expenses that you have incurred, and then you transfer those information into iTax. Now, the due date for capital gain tax payment shall be the area of the receipt of full purchase price by the vendor or the registration of the transfer instrument in favor of the transferee. Now, at this point, I want to show you how to declare this income in iTax. And I will take you briefly there, how to go ahead and declare your income. Now, this is what you do. You log into iTax. Of course, now when you're selling a property, you can sell a property as an individual or as a company. Now, the login details will depend. Like this case, I can assume I'm selling as an individual. Can assume I'm selling as an individual. Now, you come to payment registration. Come to payment registration. Then on payment registration, you say you want to pay income tax. And then here you are going to choose capital gain tax. To come and choose capital gain tax, you will be directed to declare now what kind of asset are you selling. Capital gain tax 1, land and building, for partnership. You are selling shares. You are listed as Nairobi International Financial Center Authority. You are selling shares of partnership. You are selling or you are exempted. Yeah. You can also be, if you are exempted, means that you are selling the asset, but you are exempted from taxes, especially when it comes to the religious organization like churches and other category of family trusts that are exempted from taxes. So in this case, let me say I'm selling land. Then you see all this line up here. It depends on if it is the initial stages to say I'm making payment registration. Then you'll come here and you put the details. Like the land you are selling should have the land rates number. You'd bring the land rate number here. Let me say, I'm just putting this one for demonstration. Year of purchase, when did you purchase this land? Remember, if this land you inherited, you put 2015 because that is when the capital gain tax commenced. Otherwise, year of purchase depends. If you're doing business, maybe about this land 2022. Date of transfer, when are you selling this land? Maybe I'm selling this land today, 12/07/2025. Of the transferee, whom are you selling? Whom are you selling the land to? Transferor, you are the one. Transferee is the one person buying the land. Whom are you selling this land to? Yeah. You can decide to pick any. Maybe I'm selling this to this person. Yeah. The name will come there. Then you're going to add. Do you want to add details? You're going to add. Then the details will come here. And then you're going to choose other payment options. Then you come to the next part. The next part here, you are going to fill the PIN of the owner. That means I am the one on the PIN of the owner. Were there losses brought forward? And then the ratio, if they exist. Yeah, this one I don't have the ratio. I can give it 100% or I just write one. Loss in case there are losses, like I can say there are losses maybe 2,000. But you cannot sell the property at a loss. Next is transfer value details. Here you are putting seed value consideration, cost of the sale, cost of properties that was sold. Now here you can talk of, I bought this property at 7 million, or I sold this property at 7 million. Deduct incidental cost. Description, here you can say legal fees, and then the legal fees value is 3 million. Legal fees is 3 million. Now, adjusted cost of enhanced value, if any. Now, you see, we have it cost 3 million. No, I sold 7 million, and I have a legal fees of 3 million. So the cost of acquisition now, in this case, I will come here and bring 4 million. Yeah. It is going to appear here. That is the cost of acquisition. And then here you'll find the summary of the information. The summary of information is that I have a land that I've sold 3 million. I will have allowable expenses. Now I sold 70 million. I will have allowable expenses as 3 million. And then I will come and the tax will be on 4 million. When I this detail, when you submit this detail, then you are going to pay 15% of 4 million. Yeah, you're going to pay 15% of 4 million. The only thing is that I did not. This one I was to add and not add this one. Oh, yeah, that's it. Yeah, that's for that. Now, yeah, that is it. I don't know whether there is any question on this one. Now, the only thing I want to mention here is, you see the other things here, payment amendment, maybe you make a mistake or you made a mistake after submitting interest payment registration, penalty payment registration. You see, when you don't obey or you don't comply with the law, then there will be interest registration. Then there will be penalty registration based on the system. And finally, there is payment amendment in case you made a mistake when you are filing your return. So each and every item will change depending. If I do the same and choose another asset, you will see the process will, you will see that the process will change, or the items under consideration will vary because of the nature of the asset. Come here, payment registration, go to income tax. And then this time I'm not selling land. Let me go to capital gain tax. This time I'm not selling land. Let me say I'm selling shares. When you're selling share, you'll see what I want to demonstrate here is when I'm selling shares, I'm going to put the date of transfer. You see some areas has already been populated. This time I'm not filling this part. It's already been auto-populated. Date of transfer I'm going to fill here. And then I'm going to bring the transferee details. When you come here, you'll find number of shares. Maybe I'm selling 8,000 shares, and each share is maybe 200. Yeah. Please some data in this. Yeah, that's okay. Now, you see, I'm selling 8,000 shares. Each share is 200. They could compute the total amount. Incidental cost, maybe I'm going to add, I'm paying lawyer. Description, this is legal fees. Legal fees, and then the legal fees, maybe out of 16 million, let me say I'm paying 500,000 as legal fees. Then you're going to add this part. You're going to add this part that is giving you the legal fees. You see, automatically it has subtracted. It has subtracted the cost with the fee so that your computation will be based on 1.1. If there are other adjacent cost, number of securities, in this case, if you have incidental costs, we have already captured mine there. I don't have to fill these details again, but this part is, here we are number of securities here, you are selling, how many shares are we selling in the other part? We are selling 8,000 shares at 200. 8,000. Price per share, we are selling is 200. And then it's 1.6. Adjacent cost, you see how we say this legal fees. Legal fees, and then we're having 500,000. You add this one, it will give you I added, no, adjacent cost is the one that, sorry, the adjacent cost is the cost, it is not, the incidental cost is the one that bring the asset down. Adjacent cost is the cost that bring the asset up. Like, what can you say? There is appreciation of assets, maybe, and what else can we say about adjacent cost? Something, that's why I'm saying I did not, if there was incidental cost is the one I should have brought in here. Incidental cost on adjusted cost means, you see, that's why I was saying each and every item will have its own different value. In sale of land, the incidental cost, we had incidental cost that was reducing the price. Even you come here, there is transfer value details. There is incidental cost that is bringing the item down. This is adjusted cost, the cost that maybe your assets, when you're selling this, your asset, there is an appreciation of assets, or the market prices have changed. So that is what we mean by adjacent cost. Each and every item will have its own different treatment. And then here you're going to find the summary of your information. Remember, this one was the first case, and then this figure will add up to 2.1 million. In case there was nothing here, if I remove items treatment in this category here, I put 0 here. I also remove item here and put even 2 shillings. There's no problem. 2 shillings. Here I put 1. I put 1 shillings. Yeah, if you see a legal fees, okay, this one I can delete. Then you come to the summary. Then you are going to find the treatment of your items. You had 11.1 11,100, but there was still, what do you call this? There was still legal fees on adjusted cost. That's why the prices are going down. Otherwise, that is the treatment of capital gain tax. The only thing else I want to mention here, and I want to emphasize, that when you are making payment for capital gain tax, you need to prepare a short income statement that relates to the item that you are selling. Once you come up with the income statement, then it becomes easier for you to populate iTax with information that you have already prepared. It's the same way we normally do with the India returns. You prepare a balance sheet, you prepare income statement, and populate your iTax ledger with those information. Same thing happens to capital gain tax. When you're selling your land, you need to prepare a short income statement, then which will capture your incidental costs. And if the you see incidental costs when you're selling land, and when you're selling shares, there may not be the same figures. Land, you might have agreed, I'm going to sell land at 2 million today. Even tomorrow, that value of land will be 2 million. But you agree, I'm selling shares today, 5 million. By the time you are declaring or you are coming to sell your shares, they have already dropped or the prices have already increased. So that means there will be changes in your selling prices. Otherwise, I don't know whether there is anyone with a question so far.
Yes, John, I do have a question. I have two questions.
Mm-hmm.
One, when you are doing the capital gains tax transfer,
yes.
No, not sorry, registration, there's a place you said ratio and you put 100%. Does
Yes.
that mean like you are the
you are the owner
have
of
the
that
full
property?
ownership?
Yes.
Okay. Then another question.
Yes.
What happens now when there are maybe 3 people on the property? Do
everyone is going to declare that sale in the account and indicate the ratio.
Oh, okay.
Yes. You are like you say, I'm selling this one, my ratio is 50% or 20%. The other person is going to declare the same. All of you are going to declare the same asset. You have sold the same asset, the same thing until you have paid the necessary capital gain tax.
Okay, okay.
Yeah. Any other question?
Yeah, John, on the rates, you mentioned that capital gain tax is 15%.
Yes.
And then in the note, I saw something like 20%. Please tell me the difference.
Wait, let me see where did we get 50%?
15. You said 15 somewhere.
Yeah, it should be 15. Capital gain tax should be 15%. Did you see?
Like in the notes, the very first part.
Oh, in the introduction.
Yes.
Oh, I get you. Okay, I will go there but let me. Is there any other question on this area, or I go direct to what you're asking? Anyone else who has a question here?
For me, I'm comfortable.
Okay, everyone is comfortable here. Let me go to that part. Let's see, log in here. It's no problem. KRA home.
Up there.
Yeah. Up.
On the
it should be an introduction, isn't it?
Okay, on this first part.
Uh-huh.
Like what is capital gains, these details.
Uh-huh.
I want to understand where the 20% is coming in and the 15% you mentioned.
Where the 50%?
15.
Yes, the capital gain tax should be 15%. In fact,
what?
it is written here. Look here. The rate of tax is 15% of the net gain.
Okay.
Yes.
Okay, now this could be my next question. Help me understand this first part where it has a bit of non-resident, resident.
Yes. Here.
Yes.
Okay. Begin with the first part. Here they're defining what capital gain tax is all about. They're saying, one, if there are gains which accrued to a company, an individual or partnership, on or after 1st January 2015 on transfer of property situated in Kenya, acquired on or before 2015, there is gains arising from the sales of shares, comparable interest in foreign entities, which derived more than 20% of their value directly or indirectly from immovable property situated in Kenya to a capital gain tax in Kenya, effective this. Then this last part is for non-resident. They are saying this.
Yeah.
Clearly, capital gain tax will also apply where a non-resident person who holds more than 20% of the share of a Kenyan company directly or indirectly disposes of their interest. Meaning, if you are a non-resident and you are in Kenya, if you are selling your shares and these shares constitute 20% of the share capital of the company that you are disposing your shares, then you pay capital gain tax. If the shares are less than 20% of the share capital of the company, then you don't pay capital gain tax.
Oh, I get it. I get it.
Yes. Anything else? Now, it appears we are done. It appears we are done here. Now, we are going to break and then we meet at 5 and finalize on value added tax. If you want to look at how to file VAT returns, that will be our last item for today. Otherwise, we can stop there at this point.
Thank you.
Welcome.
Thank you.
Okay.